What's going on, guys? And today we've got Jerome Powell and the Federal Reserve in the driver's seat. They control every single market, which is kind of ridiculous that one person controls everything. Everything in the entire world and the financial world is staring at this guy to see what he's going to say and decide how they react. But that is where we are, and he decided to raise the interest rates, the federal funds rates, by 75 basis points, which was the expected amount. A lot of people were worried about 100 basis points or 1%, and people were talking about 50 as if that was even a possibility. But now the market reacted, and it was not good. Even though it was exactly what the market was expecting, it still fell pretty hard. And this kind of goes through some of the points here. We know that the Federal Reserve upped it by 0.75% for the third consecutive time. Central bank continues to try to tame decade highs in inflation. And this is actually, so this right here, 75 basis point rate hike in a row is unprecedented since the Fed explicitly started targeting the federal funds rate to conduct monetary policy in the late 1980s. So this amount of time that they've upped it by 0.75 and continued upping the rates is unprecedented, never happened before, completely uncharted territory. And the rate right now stands to a new range of 3% to 3.25%, highest level since 2008, from a current range between 2.25 and 2.5, which is another big deal because it's another unprecedented type of move for the last multi-decades of the federal funds rate right here. Where this chart's not updated, it's from the Fed, but it's not updated. So this is the latest is 2.3. It's at 3% or 3.25. So it's actually above where it was in 2019 here at this peak at 2.45. So it's above where it was the last peak. And you can see from this chart, that hasn't happened. This goes back to 1990, even a little bit before 1988, that these peaks just you didn't go back above the previous peak once rates started going up. So we had the peak here, rates went down, coming up to kind of this kind of period where it's pretty much staying the same, no real peaks and moves ups and downs, to here where we're at 6, all the way down, didn't get back to 6 at 5, all the way down, got up to 2.45, all the way down, and now we're actually breaking it for the first time in multiple decades. What's that going to do? I don't think anybody really knows. Kind of just playing the game right now to see how high this rate can go until something breaks, because something is going to break at this rate where the amount of debt that we have is massively more than what it was when rates like this started to really go up and rates started to try and increase. The debt's massive, so the cost of the debt's massive the higher the rates go. It's the cost of housing is massive the higher the rates go. That's you can actually see that right here, a very good indicator of the cost of housing and all this stuff with just rates. You can see September 2020, median house price $337,000, and the interest rate for mortgages was 2.86%. Means over the total 30 years, you would pay back just over $500,000. And now, 2 years later, the median home price has gone up to $440,000, and the percent is up to 6.5 almost. And that means you're going to pay back almost double what you did just 2 years ago with the same kind of scenario. So the rate really has an effect. So the price did go up considerably, like $103,000. So a house costs $103,000 more than it did 2 years ago. All the money printing, inflation, everything that happened affects that. Just the rate going up like 4%, a little less than 4%, means the housing price went up $103,000 for that house, but the cost of that loan has gone up 100%. It's doubled from $500,000 to $1 million. The cost of that stuff, simply because the Fed needs to push these rates up to fight inflation, and housing is getting massively expensive, which could mean that the housing market would be in trouble of a collapse, or maybe not a collapse, or a crash at least, because this cost is it's very drastic cost for housing, and also kinds of prices people out of housing, because the median price, people aren't ready to pay almost $500,000 for a house, and on top of that, pay back in the mortgage $1 million over 30 years. It's a lot of people just Can't do that. So that's another big problem we have right now. Some quotes from Jerome Powell saying, "My colleagues and I are strongly committed to bringing inflation back down to our 2% goal." That's obviously, he's been reiterating that. He's been saying that every single time. That's kind of what the market is looking at too, because he's getting more hawkish, more worrisome. People are more worried of a Paul Volcker type of event, and the market doesn't want to get caught off guard with that, because that would be drastically bad for the market if the interest rates all of a sudden shot up to inflation and shot up to 9%. That would be devastating for the market. And you can see during the Q&A, Powell said, "We're focused on getting inflation back down to 2%. We can't fail to do that. I mean, if we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus," which is still kind of interesting, because to say you're all worried about the people that you serve, you weren't worried when you were printing the money. Everybody was talking on Twitter saying this is a bad thing. You can't just print all this money. Well, the Fed said, "No, we're smarter than you." And then all of a sudden, here we are with record high inflation, devastating cost of living, and nothing really going right. And another thing here to talk about inflation, when they are using these new numbers, saying they expect inflation to drop to 2.8% or 3.1% on a core basis in 2023. Then officials projected 2.3% in 24, followed by 2% in 25. The core inflation rate, though, takes out food and energy, because who needs food and energy to live? You know, you don't need to eat or use electricity or use gas. You just don't need that for life. So I don't know. The focus on the core is to get rid of the volatility, but the thing that people are spending the most amount of money on is rent, which is skyrocketing. And that can be tied to the interest rates the Fed's doing, food, which is skyrocketing in cost, and energy, which is skyrocketing in cost. So if you take two of those three and throw them out and say, we're just not going to look at those numbers, you get a little bit misleading of a stat. Even if core goes to 2.8, but food and energy is still moving up or still elevated at high levels, you still have a big problem. And right here, even if the Fed raised 100 basis points today, that was before the 75 basis point news came out, they would still be further behind the curve than any other time in decades. So you can just kind of see the similarities here, where we have never had this such a massive gap between the federal funds rate, and this is the US 2-year. So this bond at 4% and the fund rate at 2.3, now 3% to 3.2. So now it's this gap is massive, and you can see looking back, we don't ever have such a massive gap in this chart here from the funds rate to a bond to the 2-year bond. It doesn't necessarily always correlate, where we can see this kind of tapering off and this moving down, and also it's leading here where the rate is higher than the federal funds rate, but it's that gap that's the big problem, where right here is where the funds rate is, and all the way up here is where the 2-year treasury bond is. And as for how much more can the rates go up, because this is the only thing that all markets are looking at, is the federal funds rate and Jerome Powell on his meetings. What is it being raised by? If it meets the market expectations, then the market's going to collapse like it did. If it goes worse than market expectations, market's going to collapse. And if it does better, I mean, the market might still collapse. So there's really no good situation here. But Fannie Mae, which is a federal kind of government company and program, but they see the federal funds rate topping out at 3.5 to 3.75% in early 2023, which would mean we're pretty much there. This is at the federal funds rate right now is at 3%, 3.2. If they think that it's going to top out at 3.5, 3.75, maybe there's one more hike in there before leveling off and starting to ease, which could be a good thing for the market to wait to see that happening. This all depends on what CPI does and what the data they look at does, because if CPI doesn't come down and continues even staying elevated at these levels, they're going to be more hawkish, keep pushing these rates out. But this is a government company, so maybe they know a little bit more than me and you here looking at everything else. So for now, every eye is on Jerome Powell every single time he talks, every meeting he has, every leak that comes out. The market is only fixated on that, doesn't really care about much else. And until inflation is under control, or the Fed says that they're going to be less hawkish, or they prove that they're going to be less hawkish, maybe stop upping rates. Something has to happen to get the attention off of Jerome Powell and the Federal Reserve before, anything else can matter. And until that moment happens, it's probably going to be a pretty tough market out there. But that's going to do it for this video, guys. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. I'll see you guys in my next video.